All right, everyone. Welcome to our webinar on options for monetizing mortgage REIT managers. First, I'd like to thank our friends at Houlihan Lokey for participating in today's webinar. In the webinar, we will discuss various forms of monetization transactions, including internalizations, manager sales, manager terminations. We'll also touch on current market considerations, as well as tax implications and best practices for boards and special committees that are considering monetization transactions. So with that in mind, I would like to turn it over now to Jen Fuller of Houlihan Lokey.
Hi, thanks, David. So I think what I'll do, David touched upon the types of transactions that we'll be going over. I'm going to go to page 4 and start with internalizations. We'll go over internalizations, company sales with manager changes, and then manager sales and externalizations. So I'm going to limit my comments to the mortgage REIT sector. This is quite different than the equity REIT sector. And the point that I want to make on this page is within an external management universe, there's more than one type of external management. Specifically, when it comes to internalization pressure, what I would call captive managers are most susceptible to that when it comes to their public shareholders. So a captive manager is effectively an external manager that only manages one mortgage REIT or primarily manages one mortgage REIT. And the significance of that is that the company has difficulty speaking with investors once it is up to scale about why it's actually externally managed. Because they can't make, there's not a big argument about the benefits of the overall platform, and the overall manager platform could be internalized. The mortgage REIT space generally is tolerant of broader manager platforms where there are resources at the broader manager platform for the mortgage REIT, particularly when it's subscale. I'm going to skip to the next page, and I want to reinforce this point about the way that the market views internal versus external management and captive versus non-captive external managers. So while you do see more of a differential in the equity REIT space, the price book trading multiples over time in the mortgage REIT space are quite different. So you see here that internally managed companies, and we've picked a period here where you do have significant periods where these companies are trading below book, and this is a median of the companies of the peer group, not a market cap weighted. They would be higher if they were market cap weighted, but the internal median is about 95% of book. The large external manager median is about 91% of book, and then the captive median is about 86% of book. So you do see sort of a 9% spread between the internally managed companies and the external captive managed companies. So there is a difference. And you also see the captives tend to be smaller. And so there's a bit of a chicken and the egg thing where, is it smaller because they are trading at lower multiples and don't have as much access to capital? Or do they not have access to capital because they're smaller and but there is a difference, and this is all the more reason why for captives to consider internalization transactions. I'm going to go to the next page to talk about the benefits of these transactions and the considerations that boards and management teams need to think about when they internalize. So the benefits, I think, are fairly obvious. The shareholders after an internalization own the platform value of the company. They have the team, they have the analytics, they have the originators, they have all of the benefits of the business, not just ownership in a portfolio of real estate credit assets or real estate debt assets. The expense ratio, once a company gets up to scale, is likely lower. This has been something that most the companies that have internalized have actually talked about. When you're smaller, it may be economical to be external. When you're larger, it's not as economical to be external. The one that shareholders particularly dislike is the conflicts of interest and what they view as lack of alignment, some of which is perceived and some of which is actual. But you're mitigating that when you internalize. You are potentially reaching a broader group of institutional investors who don't have an interest or are skeptical of external management. Your board can better influence the company when it comes to both strategic direction and tailoring compensation for the executives to be in line with performance. what you need to think about is how you talk about this to the market. What's the quantum of the cost savings? What are you really buying? What is the REIT really buying when they internalize management? A good time to internalize, if you're paying an internalization fee, is when or fee on internalization is when you're large enough that there are significant cost savings. Compensation for executives, that is obviously public once the REIT is internalized, and so you need to be considering that. Required transition services, these are typically done with a transition services agreement with the old manager for the transition. Thinking about what manager capabilities are lost. And finally, the creation of goodwill. So managers usually don't have a meaningful balance sheet. And so the internalization for a consideration will create significant goodwill. And that's going to impact the tangible book value. And one needs to think about how that's going to be valued going forward in the market, because what you may be doing is paying for the cost savings up front, and all the cost savings do is take you down to a sort of a expense ratio that's closer to peers. But those are the key pieces, and we actually see the numbers on the next page. So on page 7, I've outlined 4 precedent mortgage REIT internalizations here, and these are those that have been done in the past decade that have been internalized for material consideration. There are another 4 that, whether they did not have a termination fee or there were other considerations, were internalized for negligible consideration. And then there are transactions in the mortgage REIT sector where the REIT has merged with their manager, or merged with a manager or affiliate that has provided services and may originate and that sort of thing. And we're not including that here because we're trying to strip out sort of pure internalizations. But you can see here that the multiple of cost savings in these transactions has been 6 to 7 times. The consideration on trailing fees has been sort of 3 to 4 times. And then you can see the consideration as a percentage of market cap and common equity, and that's what really impacts shareholders. The latest 12-month fee multiple is somewhat akin to, while internalizations are typically not technically terminations, they can be negotiated for any type of consideration. The contractual termination fee for mortgage REITs, most mortgage REITs with a couple of exceptions, is typically 3 times base plus incentive fees paid in the average of the last 2 years. And so you see, while we're not using the same definition, that this sort of 3 to 4 times number is basically in line with that. Companies like AG&C have also talked about their combined expense ratio. So when they internalized, they talked about a combined expense ratio of around 88 basis points a year, which would put them in the range of being the residential mortgage REIT with the lowest expense ratio, and that's part of how they talked about this to the market. I also want to touch on M&A transactions on the next page, and there are multiple types of those that need to be separately considered. So you could sell your REIT to an unaffiliated third party, and in connection with that, there's a new manager, and there's either a termination fee or a consideration fee paid to the old manager. A sale of the REIT to an affiliated buyer, there have been a handful of those in the past, or a sale of the manager to a third party, or an externalization or similar transaction that primarily just involves the manager and not a change of control of the REIT. The things that I would point out here are the unaffiliated sales have generally been efforts for the buyer to increase their capital base by doing sort of stock for stock transactions, most of which are done at a discount to net asset value, which lead to some accounting bargain purchase gain. So they're effectively neutral to slightly accretive capital raises. The sale to affiliates is typically either arbitrage, the desire to provide a quick solution, or desire to add float to an affiliated company. So a couple of examples are, there was a Hypo back in 2008 tendered for an affiliate, a REIT affiliate that they took public It's sort of pre-GFC called Quadra, and that was a tender offer for cash. Apollo in 2016 merged the commercial and residential mortgage REITs. They transitioned the residential assets into commercial assets, and the buyer was trading at a higher multiple than the seller, which is really a requirement to mathematically making these transactions work. On the unaffiliated buyers, you typically want to, boards are looking at the liquidity of the stock that they are trading into and what that does for shareholders, particularly where there is a subscale seller. We are seeing more interest in this environment for what I would call take private transactions. So people who would pay cash for a mortgage REIT as a way to effectively acquire a portfolio below its net asset value. Importantly, in the unaffiliated buyer sort of bucket of transactions, the ability to recycle capital into recycle the target's capital into the buyer's target assets is important. So, for example, an agency REIT seller would be an ideal seller because nearly every buyer, given that they are assets with QSIPs and level 2 assets, nearly any buyer would be able to find a way to sell those assets and then reallocate at the right time and reallocate that into their target assets. For companies with illiquid assets, for difficult to manage credit assets, the buyer really needs to either have in-house capabilities or the ability to arrange capabilities to manage those assets and sell assets when they're ready and recycle those into their target assets. For the affiliate transactions, affiliates are actually often very competitive buyers because you don't sometimes often the termination fees waived because the manager and its affiliates keep the assets under management. You're sort of moving fees from one vehicle to the other in the case of a stock for stock merger, and so given that there's no termination fee payable, you can be much more competitive on the purchase price. They often have a significant cash component. They're not all stock for stock. There's little risk that the buyer understands the seller, so there's very little risk in execution. And then there's a precedent for tenders and second step mergers, meaning you don't have a full shareholder vote. You do a tender, and once you've got the majority of the shares, you can close on a second step merger. So it can be a little bit faster than a true purchase, where you need a target shareholder vote. These affiliate transactions have heightened scrutiny, so the process is incredibly important. There may be more disclosures required later on, and so documentation is always important, but it's very important here. With these processes where there has not been a broad process, there often has been a go shop provision in the agreement so that there is a period where other buyers can emerge. That generally doesn't happen because you've got the competitive advantage of no termination fee, as well as for the manager, as well as a termination fee in the agreement for superior proposal. And then I'm going to talk in a minute about sales of the manager, and so I want to hold until then, but just generally this category involves transactions that don't lock in a discount to book value or a specific value to REIT shareholders, but are structured to provide the REIT shareholders with additional capabilities that can be accretive to shareholder value. But they don't provide a full resolution for a company that is looking for a full resolution for their shareholders or liquidity to their shareholders. The other point I want to make on page 9 is that mortgage REIT, in almost every circumstance, if we can turn the page, in almost every circumstance, mortgage REIT management contracts are structured so that the base fee is payable on a definition that's called something like equity, but not defined as GAAP equity in the management agreement. And it doesn't include certain one-time items. It doesn't, gains or losses, decreases in book value because of change in the value of assets are not incorporated in equity the same for the management agreement, the same way they are for GAAP equity. And so the impact of that is that the management fees don't go down in lockstep with equity in a challenging environment. So you end up with high fees and high expenses. And because the termination fee is a multiple on trailing fees, you end up with high termination fees. So you can see here on a median basis, and then it becomes even more onerous when these companies are trading at a discount to book value and you're trying to get a deal done at a premium to their market price, but the termination fee on that market price is quite high contractually. So you can see here that for the biggest group of mortgage REITs, the median is around 8% termination, estimated contractual termination fee to market cap. It's 9.7% for mid-sized, and for the small caps, it's about 12%. So when you've got a contractual termination fee that's about 12% of market cap, the math of a transaction, because you've got to offer a premium to the current, a buyer wants to offer a premium to the current market price. They want to incorporate the termination fee into the transaction economics, and they want to avoid meaningful dilution to book value from issuing a lot of shares. So that makes the math very difficult. In the next page, you can actually see how this manifests itself in M&A transactions. The termination fee is typically harbored by shareholders, sometimes more the buyer, sometimes more the seller, sometimes shared equally by both. And occasionally the buyer's external manager chips in cash to pay the termination fee, but that doesn't always happen. So internally managed companies have the potential to earn higher premiums to market. You see that here in the graph on the right. This is a one-day price premium at announcement, and you can see that affiliated and externally managed targets have lower premiums, whereas internally managed targets have higher premiums. And of course, affiliated targets, the affiliate needs to beat the unaffiliated, sort of the value that could be received from an unaffiliated target, but they're still externally managed. So you can really see it in the results here. I would say also that there tends to be a difference at announcement as to where these various groups trade, and we're just focusing on premium, but there is a differential.
Hey, Jen, can I ask you a question?
Sure.
So in today's environment, how should a sponsor that's thinking about forming like an externally managed mortgage REIT, design these fees in the management agreement so that they can, have the ability to do one of these transactions in the future to maximize value?
Yeah, so I think first of all, I think that how these are structured initially is really important, because in order to maximize your own value, you want to be appropriately compensated. And so making sure that you have a termination fee, making sure that you are balancing the potential to earn on your management fee with, for example, giveaways of fee share to external investors, I think is very important. But I think at the end of the day, for a manager, once you undertake a process where, as an executive and a partner in the or an LP in the or a partner in the manager, you have different interests than shareholders, you can always negotiate a termination fee that is lower than the contractual termination fee, but that becomes a minimum for the consideration. So I think from a manager's perspective, making sure that you are at a market clearing structure, and that you are getting appropriately compensated and looking at the benefits and considerations up front. I think that later down the road, you can consider whether you want to negotiate the fee to a different level. I'd like to sort of flip to the next page and talk a little bit about other creative transactions that could be done to monetize the value of the manager. So this is a group of 4 completely different types of transactions, but it can give you a sense for the range of potential. And in each of these transactions, even though there was effectively a change in the manager, there was an aspect of this that didn't just involve the manager. The transaction involved something that had benefit to shareholders. So, for example, Capital Trust externalized their management to Blackstone. They sold some of their assets, asset management assets, to Blackstone in the process. But Blackstone also made an investment in the company, a 17% stake, under 20%, so they didn't have to have a shareholder vote. They had a special dividend to shareholders around. They didn't have to have a shareholder vote on that. They had a special dividend to shareholders close to closing. The investment was at a 31% premium to the average trailing price. And then Blackstone, with their resources, was able to turn around, and in May 2013, after this December 2012 transaction, raised $660 million at a reverse split adjusted price that was higher than where they even made their investment, which was a 31% premium. So shareholders then were sitting at a premium of more than 50%. So that was enormously successful. Northstar, having a manager, internally managed, embedded manager that had operations outside of management of the REIT, spun off their manager at a time where I think both companies would have had a market cap of around $3 billion. And the market at that time was particularly receptive to that. And so on a combined basis, the shareholders of the REIT got a premium of, one day was 20%, and through the 3-month anniversary of the spin was 35%. So they used arbitrage to do that. Others have used arbitrage to internalize larger managers. So seeing where the market is and what value could be created is important. And then the next two transactions were transactions where the manager was sold and affiliates or partners of the manager actually made investments in the REIT. In the case of Hunt buying the management contract of Five Oaks, they made a common equity investment in the company at a premium to book value. And in the case of Exantis, where Exantis needed financing to stabilize the company and the balance sheet, partners of the buyer of the contract, Acres, actually provided financing in connection with that transaction. So there are options outside of traditional M&A, but it's important in the context of that to consider what other options may be available to REIT shareholders vis-a-vis some of the other transaction types that we're talking about. I want to go back and, David, I'll touch on your question again too, which is on the next page, on page 12, which is, what do you do before you're ready to undertake a transaction to build value? If we could flip the page. So you got to establish a proper fee structure for the business, not too low, because you're not going to get a lot of benefits from being meaningfully more friendly to investors, and minimize perceived conflicts in the structure. Not above market, because that's usually not clearing in terms of attracting investor interest from people who understand the space. And you also want to think about, there's a precedent for private or small transactions to give away a piece of the management fees to anchor investors and be partners going forward, or to when you're doing those transactions, negotiate the management fee down. And that may be a wealth creating decision if you think that's going to put you in a position to generate, attract more capital and generate now and in the future and generate more fees. If not, you're giving away value that you don't need to give away. And so I think carefully considering that, also considering how those anchors are going to get out over time, because that may force a transaction or a process. And so I think you need to plan for that ahead of time. And then prudently growing capital. So long-term access to capital markets is driven by market performance, the actual individual company performance, investor perception of how good the executives are as stewards of shareholder value, and a diligent focus on the management of both sides of the balance sheet. So that's really being aware of what's available in the market in terms of at-the-market offerings, underwritten offerings, stock buybacks, stock acquisitions, because timing of those transactions is very important in growth. And before you do any dilutive capital raise, investor reaction needs to be considered. On the next page, the point I do want to make on the next page is typically when there's a monetization transaction, there is a specific catalyst for it. Generally, management teams don't say this is a time where we could receive a high value for our manager because we're doing well. There's a lot of capital growth. Typically, teams want to keep their management contracts in place. So there's either pressure from investors, there's sustained challenges to growth, and the team decides they can't overcome that. Succession planning, management transition, unsolicited interest, debt maturities, that sort of thing. And so there's usually a catalyst for it. And I think teams tend to wait for a catalyst as opposed to looking for opportunistic times to monetize. And the other point I wanted to make is teams often wait when they see challenges in the market and they think about doing potentially transactions. They often wait for quite a while, and during that time, the performance in the stock is usually negative. So that you see that in the next page, on page 14. So we went back and looked at over time a measure of what has happened to the market capitalization of companies that have undergone internalizations, manager sales, REIT sales, and externalizations over time. And in the year prior, the way that we've measured it, in the year prior, you've had an erosion of market cap of 20 to 25%. And if you look further at the situations, you often have, while it takes a few months to conclude any transaction, you do often have a period where there are declining conditions. The management team works to keep the company, the management contract in place, but works to sort of tackle the issues that they're facing. And over that time, there's generally erosion of value, and that plays into ultimate value received by shareholders, and to an extent, value potentially received by the manager. The other point I want to make on that front is that these catalysts, there is a process that I think the Mayor Brown team will talk about in mitigating conflicts and establishing appropriate process. But it is always beneficial for management teams to be proactive and ahead of processes and in dialogue with their board and independent directors about alternatives. That tends to drive better shareholder value. That also tends to allow for transactions that both maximize shareholder value and are fair to the management teams. So I think that's one thing to consider, and particularly in this environment, if you're in a situation where you're considering a transaction, don't wait. See what's available and do the work in considering the transaction. You may be earning yourself value, and you may be preserving value for your own shareholders.
Hey, Jen, question here. It's Brian. Take this opportunity to remind the audience too, if you want to submit a question, there's a Q&A function at the bottom of the webinar. Feel free to put in your question there, and we can make it a little bit more of an interactive webinar. But really interesting to see the deterioration of stockholder value in advance of the transaction, as the slide demonstrates. But what are the benefits? And we're going to get into the director considerations that a REIT director should think about in the context of an internalization. But from where you sit, what are the benefits to REIT shareholders of either an assignment of the management contract or the direct sale of the captive managers, as you were describing it, to a new manager? What are the benefits that REIT stockholders should be thinking about?
Yeah, so you're going to communicate different benefits depending on the transaction that you choose. Sale of a manager, you're gaining resources of another manager. So you want to make sure you're putting your shareholders in the hands of a manager who either is in an asset class that's more in favor and that it has better opportunities in the current environment, or has more resources. The Blackstone transaction was an interesting example of a target that was more and more resource constrained as time went on. And Blackstone was able to raise capital around a very small vehicle, and it was very successful. You also typically want those transactions to come with some support for the balance sheet, for that to create alignment and to do something for shareholders through those investments at a premium. And that can drive a movement in stock price that's beneficial. For internalizations, it's all about alignment and lowering expenses. So it's about better economics to the shareholders going forward and better alignment with the management team. And in an M&A situation, it's about if it's a stock for stock deal, the liquidity that shareholders get on a combined basis and premium. And if it's a cash deal, it's cash premium. So, and you got to consider the specific situation of the target and how the transaction changes the prospects for the common shareholders. And each of those transactions fits better with companies in different situations.
Jen, are you, yeah, I was going to ask you, you were finished on your side of slides, kick it over to me on the tax side.
Hey,
Yeah.
let me ask Jen one quick question too. Like, as far as capital structures, what presents some of the largest impediments to doing one of these monetization transactions for an externally managed mortgage REIT?
Right. So for mortgage REITs that have a large preferred load, remember that there are management fees payable on preferred stock. So that on a common stock, that's going to overburden common stock shareholders. So if you have a manager that does not want to monetize, or wants a full termination fee, that's going to be an impediment. Shrinking equity in this environment obviously is impactful. Internalizations consume cash. So there's a consideration of what else can you be doing with your cash. So if you could be, there's long-term considerations and short-term considerations, buying back your stock, buying back your debt, investing in assets. What's the best use of that cash? And then, having significant investors that are partial owners of the manager can be an impediment. You're introducing other parties with disparate interest when you go to internalize or sell. And I think, and they are going to have their own opinions. So those are more seats at the table. And then if an internalization involves other third-party management fees, you got to be careful with the requalification test. So those are a few considerations.
Thanks.
Remmelt, I'll kick it over to you.
Okay, sounds good. So on the tax side, I'm really looking to cover kind of two topics that with the intention of tying that into what Jen was talking about. So I'll talk about sale transaction of REIT itself, and then a transaction of the manager. So on the REIT itself, generally REIT transactions are structured as tax-free transactions. Considering the broad-based nature of the shareholder base, typically it's structured as a merger, and then there's different particular structures you can set up. You can use merger entities that are LLCs or corporations. It can be a corporation for tax, it can be a disregarded entity for tax. The target can survive or the target can disappear in the sense that the merger entity survives. And then the other consideration is, is there an operating partnership in the structure, and where does the merger entity sit as compared to the operating partnership or the OP? And so the goal is to have a tax-free transaction, but depending on which merger entity you use and where it sits, the flavors are just a little bit different. In particular, in terms of how much cash can be used. Cash typically taxable, treated as boot. but depending on the specific form of the transaction, the cash consideration can be, limited in percentage, more or less, kind of depending on what structure we pick. So those are things to keep in mind in terms of, what the goals are. We've also seen structures where, maybe shareholders are, in a down environment, shareholders are sitting on built-in losses on their stock, and maybe you want to structure a transaction in a way that actually is taxable, so you can trigger the loss. So again, things to assess and think about depending on the specific facts and circumstances. If you have a tax-free transaction, so something we typically refer to as a reorganization, then tax attributes go over to the acquiring REIT. So when we're looking at net operating losses, NOLs, or capital losses, for example, they can be used and in the hands of the acquiring REIT, subject to certain limitations that you might have heard of before. There's a general provision in tax law about avoiding trafficking and losses, and so there's some provisions that limit the use of tax attributes after a transaction has occurred. With respect to a transaction on the manager, I would say as a general rule, you can expect those transactions to be taxable. So to be taxable to the owners of the manager. Typically, managers are set up as flow-through vehicles, let's say partnerships. So a transaction will be, taxable in the hands of the partners. The question then becomes, oh, what's the consideration? Is it a mix of consideration? Is it just cash to buy out, the management contract, the termination fee? Is it a transaction with respect to the entity, the management entity itself? And things to think about if you've got a mix of consideration is that, if you get, for example, REIT equity, that you got to take into account the fair market value of that equity for purposes of determining taxable income or gain. And, so you run into considerations with respect to liquidity, right? So how quickly can you sell REIT stock to satisfy a tax liability, or is the cash component sufficient to cover the tax liability? And what comes into play there also is timing. We've seen transactions that are structured in installments, and so in that case, sellers might be able to take into account the benefit of the installment rules for tax purposes and defer some of the tax due. Typically, we're looking at ordinary income rates rather than capital gain rates because management contracts are considered like a hot asset, something that gives rise to ordinary income, including upon termination. There is the possibility of structuring a transaction like this in a tax-deferred manner. The one option that comes to mind is if the REIT has an OP, an operating partnership, in its structure. Most of them do. One option is the use of partnership units to internalize the manager or in a way that can defer the taxes. It can get pretty tricky in the sense that you want to avoid, giving the IRS the opportunity to recharacterize that transaction as, really a payment, a termination payment for the agreement rather than the tax deferred transaction. So it would require some careful planning and, review of the documents. It requires careful structuring to set it up in a way that it would be successful in achieving that tax deferred. So those are the main tax considerations I wanted to highlight. If anybody has tax-related questions, feel free to throw them into the Q&A.
Hey, David, do we want to address the question in the queue? I actually think it's a really good one.
What'd you say?
There's a question in the queue that I actually think is a really good one. Should we go ahead and address that?
Yeah,
Sure.
yeah, let's do that. Yeah. So
You want to, yeah.
Yeah, for those, I'm not sure if everyone gets the benefit of seeing the Q&A, but for those who can't, it asked really what are the pros and cons of mortgage REITs acquiring full service external managers in the current environment. It references the Colony acquisition and the Rhythm transaction, as Jen earlier mentioned.
Yeah, I can start. I mean, I think I wish we covered this because this is a big trend right now. So, the Rhythm transaction. So what's really interesting is that we're in an environment where a lot of REITs have asset generating businesses that are fantastic, but they are by definition in the REIT capital constraint. And so there's an effort across the board to find different capital to actually hold those assets to maximize the platform value of the REIT. And with the Sculptor transaction, what Rhythm gets is the ability to do that. It is very difficult to create an institutional asset manager, any asset manager. It takes a long time to build that up and those relationships, and they get that through their transaction. Other mortgage REITs that don't have access to an asset management platform have formed joint ventures, are reaching out to insurance companies. There is a desire to access lots of different pockets of capital. I think this is great in this environment. I think all sorts of considerations, and it will be interesting to see how the Rhythm stock trades in the public markets or post this transaction over time. But I think it sets you up well, first of all, to give currency to the owners of the asset manager, but also to think about other transactions. The asset manager may not be large enough to be a public company on its own at this point, but to think about alternatives down the road and build a for the REIT investors a premium to book. There's probably a cap for a REIT on where a company that has a lot of income on the capital can trade just in the REIT universe. And so I think and how large that asset management operation can be and still qualify as a REIT. So I think naturally that puts you in the situation of thinking about a spinoff or a D-REIT or something like that. And it also puts you in the situation where you are going to need to explain the company to investors. It's neither asset manager nor asset company. It's probably some combination of the two, plus an asset generation engine. But I think those, just from a market perception standpoint, I think those are the pieces. But the industrial logic at this point of doing something like that, I think, is very strong. But the valuation considerations over time need to be carefully considered.
Jen, would a mortgage REIT with a full service like asset manager that sits inside of a taxable REIT subsidiary, like what would you benchmark that to as far as like trade, peers? Is it traded like a mortgage REIT, or is it traded like an asset manager, or is there some other category where you can, it's like a hybrid category?
There's a hybrid. I think there's probably a hybrid category where it depends on a couple of things. One is how well you are able to explain it to the market, what the mix of the two really is, and what it looks like predominantly to investors. So what investor universe you attract. And then the concept of a cap. A mortgage REIT investor doesn't feel comfortable paying whatever X book for something with the capital light business inside of it, or does it look more like an asset manager? And there may be a merger transaction that over time becomes a capital arbitrage transaction where you spin it or you do something else with the assets and you just become a publicly traded asset manager. I mean, I think there are a lot of different ways to consider doing something like that successfully.
I don't think it gives you a lot of optionality.
Yeah, I think so. There's some other questions on tax too.
Yeah, Remmelt, I'm not sure if you're still, but we did get a couple tax questions if you're still here. Or we could circle back to those. David, if you want to get into your section.
I think Remmelt's here.
Oh, okay, cool. Yeah, so for the audience, we got what are the tax implications on proceeds for manager externalizations in the case of an internally managed REIT? So going the other way.
So, well, let me think about that. So what, so I guess that implies a payment to the REIT. I mean, would there be such a payment to the REIT up front? Right. I mean, I guess if you've got an internally managed REIT and you go external, does the I guess the newly formed external manager, then pay the REIT for? I mean, I guess you're saying yes.
For the contract.
Are free. I mean,
essentially paying it up front for the contract.
Right. I mean, off the cuff, I guess the issue is that it wouldn't be, it generally wouldn't be, real estate related income. So it's probably not good income for, REIT income purposes.
So it'd have to go into that
but,
TRS. Yeah.
Right. Now, although it's a little weird to put it in a TRS because, if you have it, because the TRS wasn't being the internal manager to start with, right? So, but I honestly, I haven't dealt with a situation like that before where, going externally, there's a payment made, an upfront payment being made to the REIT, but my initial reaction is that that would fall into the not good income bucket. So for purpose of the 75% and the 95% test, it couldn't exceed more than essentially 0.5% of the income. Now, one option might be then spreading it out over time, right? Because it's an annual test. But would have to think about that more in a live situation.
All right, Kayla, let's go to slide 19. Best practices for mortgage REIT directors in considering any of these monetization transactions. I mean, look, the first step here is always, the board has to ask itself, what is the best alternative available for the company? And is it the proposed transaction or is it something else? With that in mind, there really is no set playbook here, and every transaction is going to present a different set of facts and circumstances. But with that in mind, there are, some best practices we'd like to highlight that allow the board to make a decision that will ultimately allow it to withstand any scrutiny. First, disinterested directors should really control the process. I mean, most, if not all, of these transactions involve actual and potential conflicts of interest between the owners and employees of the manager and the REIT and its stockholders. And it's critical to identify those conflicts early on and reevaluate them through the transaction and make sure that there is a process in place for, cleansing the conflicts. With that, to do that, you would typically see a committee of independent directors that are not interested in the transaction form a special committee. You give that special committee, committee broad authority to retain its own legal and financial advisors. And allow the disinterested members of the committee to, drive the transaction, to negotiate the terms opposite the manager and the owners of the manager, including, potentially members of management that have a financial interest in the manager and are employed by the manager. In that step, the disinterested directors should really apply, constructive skepticism to the transaction. They should understand all of the manager's interests, what the manager is asking for. Does it make sense from the REIT's perspective, what are sort of the rights and obligations of the manager and the company under the existing management agreement in connection with the internalization, who has the right to the intellectual property, what, who has the books and records, what's it gonna end up looking like if you do one of these monetization transactions and it goes sideways. I mean, there's a lot of things a lot of issues to consider, but the considerations on behalf of the REIT should be made by the disinterested directors. Second, the disinterested directors should have broad authority to retain qualified independent legal and financial advisors. The special committee needs to get its own, independent advice to make a decision that will allow it to satisfy fiduciary duties. It's important to engage legal advisors early on in the process to assist in identifying and navigating conflicts of interest. Depending on the type of the deal and the consideration, the special committee should retain an independent financial advisor that can provide it with a fairness opinion. The fairness opinion provides a basis for making an informed business decision regarding the proposed transaction, and will provide the special committee, and it just provides the basis for making a good decision. It's not the sole basis for making the decision. The directors really should devote appropriate time and attention to the transaction, ask questions, get as much information as possible, scrutinize the transaction terms. And finally, in connection with this process, you need to really make sure that you have a consistently detailed, accurate, and complete written record that documents the decision-making process undertaken in the boardroom. And it should reflect all the advice that's been provided to the committee by the financial advisors, by lawyers. For key decisions, the record should reflect, the decision that was made, the advice that was provided, what they relied on, and it should be, a comprehensive set of, minutes and presentations provided to the board and provided to the disinterested directors in making a decision on one of these transactions. Let's go to the next slide. So we're running short on time here, but most mortgage REITs are incorporated in Maryland, and Maryland, unlike Delaware, has a specific statutory standard of conduct that applies to each director on an individual basis, not collectively. In order to satisfy that standard of conduct, the director is required to act in good faith when assessing the transaction with a reasonable belief that his or her action is in the best interest of the corporation, with the care of an ordinarily prudent person in a like position under similar circumstances. This is really it's a process-driven analysis. It focuses on process over substance, and if a director complies with the statutory standard of conduct, it's satisfied its duty, and any decision to act or decision not to act is going to ultimately be respected if the transaction and the actions of the directors is scrutinized. Let's go on to the next slide. This slide is just particular practical takeaways for satisfying the statutory standard of conduct. I'm not going to go through these. We can after the webinar, we can make sure that everyone has a copy of the deck and they can take a look at this. If anybody has any questions, happy to answer them. But with the remaining time, I'm going to hand it over to Brian.
Cool. Thanks, David.
Yep.
So under common law, so a transaction or a contract like the management agreement, between a mortgage REIT and one of its directors, or a corporation in which that mortgage REIT director is a director of, or has a significant financial interest of, so think the external manager, is either void or voidable and can be rescinded in a stockholder's lawsuit. So that's under common law. As David mentioned, most of the mortgage REITs are incorporated in Maryland. So contrasting common law with the MGCL, section 2419 of the MGCL, it provides a safe harbor here for these type of transactions. So for interested director transactions, it essentially removes the taint of the director's interest in that internalization transaction, so long as you stay within the safe harbor. So under 2419, an internalization transaction in which one or more directors have that interest is not voidable solely because of that common directorship or interest or financial interest or whatnot, so long as one of three things happens. Either first, the fact of that interest was disclosed or known to the board or a committee of the board, special committee, and the special committee approves of the transaction by the affirmative vote of a majority of the disinterested directors, even if those disinterested directors don't constitute a quorum. So if you have many, interested directors, don't think that it's precludes you from relying on the safe harbor if your disinterested directors don't reach the quorum level. Second safe harbor, the fact of that financial interest in the external manager, again, needs to be disclosed or known to the stockholders entitled to vote on it, and you get approval of the majority of those stockholders. So this obviously necessitates a proxy statement disclosing the conflicts and all the proposed benefits and drawbacks and risks related to the transaction. And then in a distant third place, the contract or transaction, in order to rely on the safe harbor, needs to be fair and reasonable to the mortgage REIT. Get into here that the difficulty with this part of the safe harbor is it obviously puts the onus on the mortgage REIT and the manager to assert the fairness and the reasonableness of the transaction, as opposed to in the other direction, getting the approval of the disinterested directors or the stockholders is obviously a far more desirable way to rely on the Maryland safe harbor. Several Maryland courts have examined, whether a given internalization transaction or otherwise is fair and reasonable. And they, really it becomes a very subjective facts and circumstances analysis that very much lends itself to a second guessing in hindsight when one is outside of that safe harbor. So very important to stay within there. Next slide. So if certain members do have that interest, what is recommended and extremely useful is to set up a special committee of the board that, again, just comprises disinterested directors. It's important to do this very early on in the process. Important to document the committee's review of alternative transactions, alternative, ways to, either assign that contract or a direct investment into the mortgage REIT or whatever the alternative transactions are, especially if there is a M&A process that this leads itself to, because it is a change of control transaction. But a review of those other transactions and also a review of the material terms to the internalization. All of this needs to be documented. A properly functioning special committee should engage separate financial advisors. They should engage separate legal counsel, all to assist it in making that judgment on whether the transaction is fair to the REIT itself. Next slide. So, of course, in any significant transaction like this, you have the potential for litigation against the REITs, the REIT itself or its directors. So, not an insignificant risk. And so, as a result, REIT directors are the beneficiaries of an indemnity, and so that obviously helps to protect the REIT directors, but notwithstanding that, each director needs to make sure that they appropriately question the information provided by management, provided by the manager, and whether such information is complete, accurate, when deliberating as a committee to determine whether, this is an appropriate, transaction for the REIT. Next slide. So other legal considerations we'll wrap up here with. Important in the context of any issuance of equity by the REIT, to keep in mind of the 20% rule. Shareholder approval is going to be required for any sales of securities in a private placement that is done below the quote unquote minimum price that exceed 20% of the pre-transaction outstanding shares for the public company. The NYSE will also require shareholder approval of all cash sales in connection with an acquisition of assets of another company. So the external mortgage REIT, if it's in excess of 20% of the external manager's common stock before the transaction. Last month, the NYSE came out with a number of proposed rule changes that allow for more flexibility in terms of avoiding these shareholder approval requirements. But to the extent that they are triggered, the REIT will have to prepare a proxy statement, which will have to include detailed information regarding the financials. It'll have to provide pro forma financials, how that REIT would look if the manager was internalized, and also have to provide detailed compensation information. The CDNAs that you see for many internally managed REITs will all have to get included in that proxy statement that gets sent out to the mortgage REIT stockholders to approve the transaction. So a lot of work required in that one slide in the event that shareholder approval is necessary for the transaction. I see we're running up at the end of time here. So let me take the opportunity to thank Jen, Remmelt, David, and thank everyone for joining us today. If there are any questions, feel free to reach out to any of us directly. Please take a look at our additional resources that we have as noted on the slide here. And hope everyone enjoys the rest of their day. Thanks so much for joining us.